Investors have been fixated on the Washington crisis, the government shutdown, and the debt ceiling deadline. But there's another financial crisis looming far away from the nation's capital, and this one could have a big impact on many American portfolios. Michele Caruso-Cabrera reports on why investors should pay attention to what's going on in Puerto Rico.
Puerto Rico has some $70 billion of debt, behind only New York and California, but it has a much smaller and weaker economy compared to those states. The islands borrowed money in the past to cover pension costs and to fill budget gaps in the government, but that may finally be catching up to them. Investors have been selling their bonds for the last several weeks for fear they might not get paid back. Ratings agencies recently downgraded some bonds that are backed by revenue from Puerto Rico's sales tax. Puerto Rico may be small, but its bonds are pervasive in municipal bond funds. That's because bonds from Puerto Rico are one of the few munis that has what's known as a triple exemption. No matter what state you live in, if you own a bond from Puerto Rico, you don't pay federal, state, or local taxes on the interest. Morningstar says there are 567 municipal bond funds in the United States, and more than 400, or 75%, have some kind of exposure to Puerto Rico. While traditional investors may be selling Puerto Rico's debt, hedge funds willing to take bigger risks are buying them because they pay such high rates of interest. A bond that doesn't mature until 2039 is selling for only 71 cents on the dollar and will pay more than 8%, fully tax-free. That's a great deal if you get paid back. Puerto Rico has taken some steps recently to control pension costs and raise revenue with more taxes on businesses, which they hope will raise $2.5 billion in new revenues. But those moves could also hurt the economy and might not provide as much money as expected. Possible debt bomb you should be watching for. For Nightly Business Report, Michele Caruso-Cabrera.